Silver at $77. A year ago, analysts were saying 35 was the top. 6 months ago, they said 50 was unsustainable. Last month, they called 65 a bubble. They were wrong every single time, not because they didn't understand markets, because they didn't understand the supply crisis, and that supply crisis, the 200 million ounce annual deficit we've been tracking, didn't get solved by silver going from 29 to 77. It got worse. Today I'm going to show you why silver at 77 is not the top, why $100 is likely the floor, not the ceiling, and why 150 is the next logical target based purely on supply-demand fundamentals. No hype, just math. Let's start with what actually drove silver from 29 to 77. It wasn't the Reddit squeeze, it wasn't retail FOMO, it wasn't even investment demand, though that contributed. It was industrial procurement panic. Here's what happened that most people missed. In April 2025, TSMC, the world's largest chip manufacturer, issued a statement to suppliers. Silver availability has become a critical constraint on production timelines. Translation, they can't get enough silver to meet chip orders. In June, the Solar Energy Industries Association published a report showing that 38% of planned solar installations for 2025 were delayed due to silver supply bottlenecks. In August, 3 major EV manufacturers, Tesla, BYD, and Volkswagen, announced they were securing multi-year silver supply agreements directly with miners, bypassing traditional commodity markets. These aren't speculators. These are industrial users who need silver to manufacture products. And they started bidding against each other for available supply. That's what drove the price from 29 to 50. Then investment demand kicked in. When people saw industrial users panicking, they realized the thesis was real. ETF inflows accelerated, retail buying intensified, that drove 50 to 70, and now we're at 77 with the fundamental supply deficit larger than it was at 29. Let me show you the current supply-demand math with updated numbers. Global mine production in 2025, 840 million ounces, essentially flat from 2024 despite silver tripling in price. Why didn't production increase? Because 70% of silver is a byproduct of copper, zinc, and lead mining. Those metals didn't triple. Copper went from $4 to $5.20. Not enough to justify massive new mine development. And even if miners wanted to increase primary silver production, it takes 7 to 10 years to bring new mines online. The permitting, the infrastructure, the capital, all of it takes time that doesn't exist. So supply is stuck at 840 million ounces. Now demand. Industrial demand 2025, 730 million ounces, up from 600 million in 2024. Solar grew from 130 million to 170 million ounces. Installations accelerated despite delays. AI chips and electronics went from 90 million to 130 million. The AI infrastructure build-out is just getting started. EVs increased from 40 million to 65 million. EV adoption accelerated globally. 5G and telecom, 40 million, up from 30 million. Investment demand 2025, 320 million ounces, up from 250 million as institutions and retail both accumulated. Jewelry and silverware, 80 million, stable. Total demand, 1,130 million ounces. Supply, 840 million. Deficit, 290 million ounces. That deficit is 40% larger than 2024's deficit of 200 million ounces. Now here's the critical part most analysts are missing. They see silver at 77 and assume the price rise will destroy demand. At these prices, industrial users will find substitutes. That's wrong. There are no substitutes at scale. You cannot make a solar panel without silver paste. Alternatives exist in labs but not in manufacturing at the scale required for hundreds of gigawatts of annual solar installation. You cannot make AI chips without silver. The conductivity requirements are non-negotiable. Copper doesn't work. Aluminum doesn't work. Gold is too expensive and too scarce. You cannot build EV charging infrastructure without silver contactors and connectors. The safety standards require it. Industrial demand is price-inelastic up to a much higher level than $77. In 2011, when silver hit $49, industrial users paid it. They complained, but they paid. Adjusted for inflation, $49 in 2011 is $78 today. We're at that level now, and industrial demand hasn't slowed. Why? Because for a solar panel manufacturer, silver represents 3% of total panel cost. If silver doubles from 77 to 150, panel costs increase 3%. That's absorbable. Annoying, but absorbable. The alternative, not making panels because you can't get silver, is not absorbable. You lose contracts, you lose market share, you go out of business. So they pay. Let's talk about where the deficit silver is coming from right now. The 290 million ounce deficit has to be filled from somewhere. New production can't meet it, so it's coming from stockpiles. COMEX registered inventories in February 2026, 42 million ounces. That's down from 70 million a year ago and 180 million in 2020. At the current deficit rate, COMEX inventories will be exhausted in 53 days. Now, that doesn't mean silver goes to infinity in 53 days. It means COMEX stops being the pricing mechanism for physical silver. Paper contracts will still trade, but physical delivery will become impossible or heavily delayed. We're already seeing this. Physical silver premiums, the markup over spot that dealers charge for coins and bars, are at $8 to $12 per ounce. A year ago, premiums were $2 to $3. That 4 times increase in premium is the market pricing and physical scarcity while paper markets lag. ETF inventories are being drawn down. SLV holdings decreased by 18 million ounces in the past 6 months, despite the price rising. That means redemptions, people taking physical delivery, exceeded new buying. Government stockpiles are gone. The U.S. strategic stockpile was sold off years ago. The only remaining source is private holdings, stackers who've been accumulating for years, and most of them aren't selling at 77. Here's the price path I see developing over the next 12 to 18 months. Phase 1, $77 to $100. This happens when COMEX inventories hit critical levels and physical premiums spike to $20 to $30 over spot. Industrial users who've been sourcing through traditional commodity markets realize they can't rely on those markets anymore. They start bidding directly for mine output and recycled material. That bidding pressure pushes spot from 77 to 100. Timeline, 3 to 6 months. Phase 2, $100 to $130. This happens when mine supply response begins to show up. Not new mines, but expansions at existing operations and increased recycling. At $100 silver, recycling economics improve dramatically, scrap recovery increases, industrial waste gets processed more thoroughly, but it's still not enough to close the deficit. The price needs to go higher to ration demand. At 130, some marginal demand finally gets destroyed. Smaller solar projects get delayed. Some EV features get value engineered to use less silver. Timeline, 6 to 12 months after hitting 100. Phase 3, 130 to 150 plus. This is the speculative overshoot phase. By the time silver hits 130 based on fundamentals, mainstream media is covering it daily. Retail FOMO is intense. ETF inflows are massive. The price overshoots fair value and touches 150 or even 180 before correcting back to 100 to 120. Timeline, 12 to 24 months from now. So what do you do if you're holding silver right now? If you bought at 29 and you're sitting on 166% gains, congratulations. You recognize the thesis early and positioned correctly. Do not sell your core position. This is not the top. The supply crisis is worsening, not improving. If you want to take some profit, if 77 feels uncomfortable and you need to de-risk, sell 10 to 20% of your position. Bank the gains. Let the rest ride. If you didn't buy at 29, if you're looking at 77 wondering if you missed it, you didn't miss the entire move. You missed the first leg. The move from 77 to 150 is still available. That's a 94% return from here. Not as good as the 166% from 29 to 77, but still exceptional compared to any other asset class. Start a position, 5 to 10% of your portfolio. Don't go all in at all-time highs, but don't sit on the sidelines either. The supply crisis is real, the deficit is growing, the price must rise to equilibrium. 77 is not the end, it's the middle. Position accordingly.